All right. So let's now see, try to consider the exchange rates, right? Very, very important piece of study and topic, exchange rates. What about exchange rates, right? What about exchange rates? Okay, so look, it is very, very important that we understand the subject of exchange rate. This is because if you want to purchase, the things within the country, you can use the local currency, right? Then you can buy those goods. But if you require the goods from outside the country or the foreign goods, you need to convert your local currency to the foreign currency. So therefore, the exchange rates are set, are set in the foreign exchange rate market. And that is very, very important to understand, right? The exchange rates most of the times are determined by the forces of supply and demand, okay? And for that reason, the changes in the exchange rate have got a significant, impact on the country's economy. So the exchange rate, by the definition, is basically the number of units of the foreign currency that each unit of the domestic currency will buy, right? The question is how many of the foreign currency, the units of the foreign currency that we can buy using our local currency, that is exchange rate by definition. Okay, that is actually very important. You will understand that the exchange rates actually do change, okay? For example, when we say that there is an appreciation, okay, yes, you have heard people saying there is an appreciation. So an appreciation is an increase in the value of a currency compared to the other currency, okay? So the increase in the value of the currency, that is an appreciation of that particular currency. And when you look at depreciation, which is the opposite, is actually a decrease in the value of a currency relative to the other currency or compared to the other currency. When the value of your currency has reduced, okay, especially when you try to compare it with the other currency, that is the depreciation of that currency against the other currency. Okay, so you find that domestic currency will appreciate if the exchange rate increase. This is the direct way of looking at the exchange rate. However, you can still analyze them in an indirect way because there are two approaches that you can use to measure the exchange rate. So you can use the indirect approach and the direct approach. Okay, you can still interpret the depreciation of a currency, okay, when the units, the rates increase. Okay, that is another approach of looking at it. However, that is not really direct. Okay, so just have to get that. So now domestic currency would depreciate if the exchange rate come down. The direct way or the direct approach to the exchange rate interpretation. Now, how exchange rates are measured, okay, or determined. So the nominal exchange rate is the value of the currency. Let's say the dollar. That is the nominal exchange. The value of the currency, right? Now the value of the dollar is determined by the supply and demand in the foreign exchange market. Okay, so it is in the foreign exchange market where the value of the currency is actually determined. So you have got supply of the currency and the demand of that particular currency. So you can see that here is the amount of the currency that is being supplied and the amount of it that we can demand. Then the equilibrium point is what we call the nominal value, or the rate at which the value where the value of exchange rate that equates or that brings that market into equilibrium, where the amount of the currency demanded is equal to that one supplied. We also have got what we call the exchange rate strategies, right? Now, the foreign exchange market is the market on which currencies are traded. So the market, the name of the market on which currencies are traded is called the foreign exchange market. Now, a flexible exchange rate is an exchange rate whose value is not officially fixed. Okay, I'll repeat here. So a flexible exchange rate is an exchange rate whose value is not officially fixed. So it varies according to the forces of demand and supply, especially of the currency in the foreign exchange market. So a fixed exchange rate, on the other hand, is an exchange rate set by official government policy. So when we set the exchange rate, okay, when the government sets the exchange rate, then that exchange rate is fixed. It's not flexible. A flexible one is determined by the forces of demand and supply. Now, what about flexible exchange rate? In the short run, exchange rates are set by the forces of demand and supply in the foreign exchange market. Now, the dollars are demanded, for example, by the foreigners who seek to purchase the United States goods or financial assets. Okay, so you see that the number of dollars for the foreigners who seek to buy will be dependent on how much dollar is being demanded. So the dollars are supplied by United States residents who need foreign currency to buy foreign goods or financial assets. That is very, very important. So who is supplying us with the dollars? The US residents. They need foreign currency so that they can buy foreign goods or financial assets in other countries other than US. Now, in the same, okay, not the same as the money supply set by the central bank, number of dollars offered in exchange rate for other currencies as well. Now, look, we also have got the issue of fixed exchange. Okay, where most large industrial countries, they use the flexible exchange rate, right? Okay, now, usually the small and developing countries may use the fixed exchange rate, okay? The fixed exchange rate greatly reduce the effectiveness of monetary policy as a stabilization to the fixed exchange rate. So to establish a fixed exchange rate system, the government states the value of the currency in terms of the major currency. So they can say, okay, the value of the kwacha to dollar is this much. Then they keep quiet. That is what that means. Now, the government attempts to maintain the fixed exchange rate, okay, will be there, okay, at existing, there will be some level. The government will say, okay, let's maintain the fixed exchange rate at its existing level. Now, the government may change the value of its currency in response, of course, to the events. So the government has got all that power trying to control. Now, the exchange rate and the monetary policy, what about this one? What you'll understand is that the flexible exchange rate, they strengthen, it has strengthened the effectiveness of the monetary policy for stabilization. The flexible exchange rate will strengthen the effectiveness of monetary policy for what? For stabilization, of course, as a stabilization too. So the fixed rates require the central bank to choose between defending the currency and stabilizing the economy. You will have to choose. Should we defend the currency, the value of the currency? Should we stabilize the economy, right? So the central bank will have to choose. Now, the fixed rates can be beneficial for small economies. Yeah, we can see that. Let's cite an example of Argentina that managed to fight hyperinflation by valuing its peso on par with the dollar, right? Inflation quickly decreased according to that research, and that stayed stable for more than 10 years. The fixed exchange rate system broke down because of unsound domestic policies that were created, fear. that Argentina may would default on international loans, and that is actually what happened. However, it worked. So usually the fixing of the exchange rate works for the small countries. What about or small economies? What about the real exchange rate? Now, in the short run, domestic prices of goods are fixed, right? But in the long run, this assumption is relaxed. So the real exchange rate is the price of the value, the domestic good of the domestic good relative to the prices of the average foreign good when prices are expressed in a common currency. I'll repeat. Real exchange is the price of the average domestic good relative to the price of the average foreign good when prices are expressed in a common in a common currency. We get the common currency to express all that, then you'll have the real exchange rate. So the nominal exchange rate is the number of units of the foreign currency per per dollar in this case. So we have a lot of factors that really affect the exchange rate. We have inflation affecting exchange rate. Inflation affects the exchange rate. We also have got the interest rate, public debt, domestic political stability issues, the terms of trade, the currency, the current account deficit. These are some of the elements that affect the exchange rate. Okay, I've said inflation, interest rate, public debt, terms of trade, and the current account deficit. Then the political stability or economic performance, that also has an impact on the exchange rate. Let's try to look at them. Let's see if we can look at them in detail. One of them, the factors that can affect exchange rate. We start with inflation. Now, changes in market inflation cause changes in the currency exchange rate, right? So if a country has a lower inflation rate than another country, you will find that the country with the lower inflation rate will see an appreciation in the value of its currency. So the prices of goods and services will start increasing they will increase at a slower rate where the inflation is low. And again, a country with a consistently low inflation rate does exhibit a rising currency value, while a country with high inflation typically sees depreciation in its currency, and is usually accompanied by higher interest rate. So you can see that when there is inflation in the country, then your local currency loses value. When there is low levels of inflation, the local currency gains value or it appreciates against the other currencies. What about the terms of trade? Now, a trade deficit also can cause exchange rates to change. For example, the terms of trade, by definition, is the ratio of the export prices to imports, right? To import prices, let me say, prices. So the ratio of the two is what is called the terms of trade, okay? Now, a country's terms of trade will improve if its exports prices will rise at a greater rate than its import prices. When we have the prices of export prices increasing higher than the import prices, okay, at a slower rate, then we can see that our terms of trade will improve, and the opposite will be true. Now, this actually will result in higher revenue, which will cause a higher demand for the country currency and an increase in its currency value. So our value will appreciate when the terms of trade are better, okay? Then the local currency will appreciate because of the terms of trade that are better. What about the output, GDP? What's the impact of the same on the exchange rate? When the domestic output rises, there will be the demand for imports. That will increase and the net exports must fall. So the net exports will fall. So the domestic currency will depreciate, okay? The exchange rate will fall. So you find that when you have too much, like higher, very high levels of the GDP, people will be forced to start importing more, right? People will import more because they have enough income, they have a lot of income. And as they import more, what they are trying to do now is to demand more of the what? They will demand more of the other currency, the foreign currency, because they're importing more. As a result, then the local currency will not have a lot of demand. And as a result, it will depreciate. That is how GDP or income level affects the inflation exchange rate. What about interest? Now, if the domestic country is real interest rate rises, other factors held constant, of course, ceteris paribus, then the country real and financial assets are more attractive for investment. Okay. If our, real interest rate rises, then you find that our assets will become more attractive. People would want now to invest because of higher interest rates. They would want to give us money, invest, because they will get a lot of return. Now, the demand for domestic currency will increase and the exchange rate will start appreciate. Then you find that our local currency will gain value, right? Our local currency does gain value when the interest rates do rise, okay? Or of course, to make our local assets or more attractive to the investors. What about the government debt? Now, a country with government debt is less likely to acquire foreign capital, leading to inflation. So foreign investors will sell their bonds in the open market. As a result, a decrease in the value of the exchange rate will follow. We'll have a decrease in the value of the exchange rates because of the same. Shall we consider now the issue of fixing the exchange rate? Fixing the exchange rate. Now, in a fixed exchange rate regime, the value of the nominal exchange rate is officially set. So now, if you set the value of the exchange rate, there will be some times when you will overvalue the exchange rate or undervalue. If you overvalue the exchange rate, okay, overvaluation of the exchange rate is a situation when an exchange rate is higher than its fundamental value. That is overvaluing the exchange rate. When an exchange rate is higher than its fundamental value, okay? Now, in a situation of an overvalued exchange rate, a government can, number one, devalue its nominal fixed exchange rate. It can still restrict the international transactions and buy back its currency in foreign exchange market. Try to buy its currency in foreign exchange market so that it can be of low supply, and as a result of that, its currency will have more value because it has become scarce. Overvalued exchange rates. Now, to support the domestic currency, the central bank must use the reserves that correspond to the country's balance of payment deficit. So it cannot do that forever because the amount of reserves is actually limited. So it will try to do that to offload the reserves so that we try to balance up the levels of exchange rate. Okay. Now, what about the speculative run, right? So an attempt to support an overvalued currency can be, ended by a speculative run. To avoid losses, that is, to avoid losses, financial investors frantically sell assets denominated in the overvalued currency, and that is what usually happens. Now, how to support an overvalued currency? How do you support an overvalued currency? To support an overvalued currency, a country could, number one, impose a strong restriction on international trade and finance. You can devalue the currency. You can make a policy to raise the fundamental value of the exchange rate. So those are the options available to the country to support the overvalued currency. Number one is to impose, if the currency is too much valued, you can devalue it, number one, or you can make a policy change to raise the fundamental value of the exchange rate. You can still impose a strong restrictions on international trade and finance. Okay, what about undervalued now? Undervalued exchange rate. We've talked much about overvalued, what about undervalued? Now, an undervalued exchange rate exists if the officially fixed value is lower than the fundamental value of the exchange rate, just the opposite, right? So an undervalued exchange rate could be maintained indefinitely if a country trading partners would not lose their reserves. But the problem is that there is the issue of losing the reserves. So benefits of fixed exchange rate systems would be less costly trade in goods between countries. There are lower transaction costs, of course. They have promoted monetary policy discipline. Okay, so the downside is inability of a country to use its monetary policy to deal with the recessions. That will be the downside of the same. Are there any questions? If there are no questions, we can end here and continue next time.